Of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN. If you have any questions, you can call in at 877-927-6648. I believe what we're looking at right now is one of the most critical weeks in the market for many, many years, at least for 3 years. And I posted into the Tiger TV the Bradley model as it existed on March the 5th of 2009. And the market actually, bottomed on the 9th of March, and then started to go up. This chart that you see in Tiger TV was actually 400 points higher than the actual low. The extension went down to 600 points. It went down to 6,400 in the Dow, which was the 61% retracement coming off the low of 1987. So it was a really big low down there. And, we'll see if it's going to be, a big bull market from here and the Bradley model fails. But, what I want to show you now that I think what we're looking at is a mirror image of this. And all I'm going to do now is to try to walk through to you folks what the Bradley model actually does, and, some of the limitations that it has, and, that it's based on cycles. It started with a book by Donald Bradley that was written in 1946, published in 1947. It was a little 44-page book, sold for $4. It was published by Llewellyn Publications out of St. Paul, Minnesota. Very few people even knew of the book. They didn't sell very many copies. And it was Dr. Ruth Miller that showed me, the copy in 1986 when we first started looking at these things. And what we did is we went back and we tested it. We saw that 1946, looked incredibly positive. That when he made the prediction for 1947 and 1946, it was spot on. It had an accuracy of about 90%. And so what we did was Jim Twentyman, myself, and Dr. Miller went to Neil Michelson at Astro Computing down in San Diego, because he had all of the Astro dates going back forever and in history forever, because they're so precise that it's easy to have. And he does the naval tables for the different navies across the world, including the United States, and these are published, and so they know where the tides are, they know where all the planets are at any particular time. So if we had that information, all we had to do was to have a database that went back far enough that we could get a sample size of well over 100. And that took us to 1886 in the Dow Jones Industrials and the stock market, when they really started to get data and you were getting prices in the New York Times and things like this. This was long before the Wall Street Journal. And so what we did is we looked at all of these and we came up with all the years, and we saw that it was very, very positive, and the actual percentage of wins over losses is going to be, a lot better, and it's just like having a PhD in economics, and it, makes it easy, to look at it this way. Now, the question is, does it work, and, how does it work? Well, the thing that you have to realize is that when you're looking at these cycles in the planetary things, that they are related to these numbers of the Fibonacci sequence that we look at. And so what Bradley did was he gave them different weights. In other words, he would take the planets and he would line them up on a scale, and I put those into the Tiger TV so you could actually take a look at it. On the top part of the scale, on the x-axis, you have the planets across the side, and then on the y-axis you have the planets across the side. And what they do is they match up. In other words, they become a positive or negative valence. In other words, an energy point. And these were determined through work that was done by Princeton University by a Dr. Burrs there, who was in charge of their astrophysics department in the late 40s. And he was the one that discovered or gave these weights of the planets based on the traditional way that astrologers had looked at these things for thousands of years, going back to the Babylonians. And so what he did was he had all of these different positive and negatives, and realized that when you're looking at these, and I know that a lot of you folks don't know, what the symbols of these things are, but basically you're looking at the Earth, the Moon, the Sun, Mercury, Venus, Mars, Jupiter, Neptune, Saturn, Neptune, and then Pluto, and Uranus, and then Pluto, and then but what happens is each one of those cycles line up. It has a different number, and the most important number that we look at for trading is Venus, because Venus is the 0.618 cycle. In other words, if you take Venus with Mars, and Venus with Jupiter, and Venus with the Earth, and Venus with Mercury, they're going to come out with relationships of 0.618 of a year. And that's why it's important for trading, because it's easier, it's a shorter term cycle, you get more hits on it, and you're able to look at it. So this is why, when we look at these things, it's not just a nominal cycle. When I first started looking at cycles, back in the late 60s, and then again with the Foundation for the Study of Cycles, and then again with James Hurst and the Profit Magic of Stock Transaction Timing and Cyclotech and all those things, those were just nominal cycles. In other words, they just added 16 and 32, and they would get to 64 and then the 128, et cetera, et cetera, et cetera. And cycles are not that way. They expand and contract, because all of these things that you're looking at are basically based on the Fibonacci spiral. That's when you look at the picture of our galaxy, you'll see that it is nothing more than the picture of a chambered nautilus, or the spiral that we look at, all the time. So this is why, we're looking at the cycles in a little bit different way, and that's what we're trying to do. Well, what Bradley did was he came up with an idea, and this is what he was looking at, is that if you gave a positive and negative picture of what the market was supposed to do, and he just took these and related it to the stock market. He didn't trade at all. He didn't know anything about the stock market, and he was basically a classical astrologer that had this idea, and no one ever tested it. I was the one that picked it up through Dr. Miller, and I started to remember, we didn't have really fancy computers back in the mid 80s, so all this stuff, we had a pretty good one, but it was not, nothing like what we have now. We can do on a matchstick what used to take a very large desktop to do it. But we took this sidereograph, in other words, a way of looking at positive and negative cycles, and he put it together for the year of 1947 to make the prediction. Now remember, he published the book in 46 for 1947. The book came out in 1947 with the prediction along with it, and it showed that it was very good. Now this is what you're looking at. If you go into Tiger TV, you'll see a thing that's called intermediate swings in mass psychology, because that's nothing more than what these cycles are. They're either positive or negative. And what we're coming into now is an incredibly, positive cycle that is ending. That's what it looks like. And, we'll look at the Bradley model as we go through. But this is how the thing was prepared. And I'm going to show the next chart into Tiger TV is from the actual book out of the Bradley book, and it will show that the prediction overlaid on what he expected it to happen, and you can see that the expectation of this was incredibly high. I mean, it just really the overall correlation of it was extremely done very well, and so we said, well, if that worked pretty good for 1 year, we must test other years, and that's what we did. We went from 1888 all the way through the present, and we still run it. And what's good about it is that you can do it years in advance. You don't have to be to wait for anything. I would put it up against any person that does any type of economics, whether, I don't care if he's a PhD from Stanford or a PhD from Oxford or MIT. I don't think anything can predict the stock market better than the Bradley model. It has some limitations, of course, but overall it's really, really good. The best part of the Bradley model are the Bradley dates, and that's what we're over right now, and also the trend of the market. It doesn't get the trend of the market wrong for a very long period of time. It usually sticks with it, pretty good, and that's what we're watching, right now. I'm going to show a few different years now, and I wanted to start with 1987 because that was one of the years that really put me on the map, because I had just started I just actually finished my book, and I had this model on CNBC. It was actually FNN in California with Bill Griffith and Sue Herrera. They invited me on, and I became a regular guest there once every 3 weeks for several years, well, about 4 or 5 years, I guess, and then they moved to New York, and I didn't get down there very often to do the show. But the year from 1987 has been one of the best years as far as calling a major correction, and it did it to the exact date. Now I want to remind you folks that on August the 25th of 1987 there was an event called the harmonic convergence. We had 5 planets at 0 degrees. In other words, they were all at conjunction. They were all in the sign of Leo, which is the the roaring lion. And this is what happened. We topped on that day, and that led to the crash of October 1987, which was on the 19th. The actual market bottomed on the 20th, and that bottom that we had on the 20th was an exact 61% retracement off of the 1982 low. In other words, the low we made in August of 82, we went up to the high in August of 87, and then in a matter of 6.5 weeks, we gave back 61% of that to the 100th of a point. And so this is where that final bottom was, and we've never come close to taking this bottom out. That's at around 1660, I believe, in the Dow Jones Industrial Average. So that was the year from 1987. And then we want to look at what happened, during the bull market that started in 2003, that led, after we had the big crash from 2000 down to 2003, the market made a very, very important bottom and rallied, strongly till we made the big highs in October of 2007 and 2008. And so this is a picture of what happened with the Bradley prediction, and you'll see that in March of 2003, and here again we're in March again, and it made a major bottom, and then predicted that the prices would pretty much be up for the whole year. And all you have to do with this is if you want to, is if the Bradley model is pointing from a low to a high, you should be long stocks. And if it's pointing between a high and a low, you should be short stocks or out of the market. On this particular one, you would have missed part of the move between July and November. Not very much, but you would have missed part of it. But then from December through January, you would have caught the rest of the move. And so this is the the value of it, that it does give you some positive expectations of where these things are supposed to go. Now, the next one we want to look at is what happened in 2008 when we were getting ready, to go down to oblivion, when the world was ending and everything, and they were giving us TARP and CARP and all the other BS that the people in Wall Street and Washington were feeding us. And believe me, that's really what it is, folks. They were out there for themselves, and anybody that doesn't believe anything other than that is really not being very aware of the situation. But as you can see, from 2008 in early April, the market was still way up in the air. The Dow was still around 13,000. The market broke, and it went all the way down to the 6,400 level, in the March the 9th of 2009. So these are just a few of these, and what we're going to do is I'm going to cover one more, and then we're going to get talking about the U.S. dollar, because we have some important things going, and then of course I'm going to cover Treasury bonds.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective and maximize your returns. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back, 877-927-6648. I'm done with the lecturing, so if you have any questions, you can call in. I thought it was important enough to describe what the Bradley does in just even if it's a brief format, the fact that it is very scientific, it does, prove itself over a long period of time, and all I'm showing you now is what it shows me, and that is that we are looking at some pretty serious negative things coming in for the rest of 2012 through 2013. And whether that's going to happen or not, I don't know, but I can tell you this, history tells you that you shouldn't fade the Bradley model very often. Especially when it's been as accurate as it's been, recently over the last several years. It's just got a very good track record. That's all I can tell you. It's not foolproof, but it does give you some pretty good cycle things to look at. And we've got a lot of cycles this week. We've got one today. We have one coming up tomorrow. That's the equinox, when we actually have, these 4. We have 2 equinoxes and 2 solstices. These are, events that are been used in science and going back to the Babylonians many years ago. It's a natural cycle. It's, how we grow our food and all the other stuff from winter to spring and summer to fall, all these things. And, that's where these cycles come from. But the thing is that when we do them the way we try to do them, where they're elliptical and they're not just static or nominal in nature, they're harder to predict. And that's the hardest part to do. Someone asked me a question about the AB equals CD patterns, that we've been looking at and been watching. The ones on the foreign markets have not been broken. None of the, like Europe, as far as the UK and Germany, they have not been, exceeded to the upside. They went up to the 786 and stopped. The New York Stock Exchange Index is just a little above the 786 level right now, completing the big ABCD. The Dow Jones is, doing the same thing. The S&P is also, making an extension in here. And I'm basing this on, where I think these cycles are coming into right now. And I could be, totally wrong. And if we're up next April, or next around the 1st of April, which is, of course, April Fool's, which might be my April Fool, then, this is certainly going to be wrong, because it's not off by more than 4 or 5 days on a long-term scale. And we have the new moon coming in on Thursday. And so that'll be, very interesting also. We have a lot of really strong geophysical things, occurring now that were very similar to what we had in March of last year when they had that big earthquake, in Japan. I'm not predicting any earthquake. I'm just saying there's a lot of similarities that are there that make these things a little bit more, difficult to see. Now, we need to get to talk about the U.S. dollar here, because we had a big pattern complete last week when we were on the air on our Thursday show for commodities. We were talking about the dollar index getting up to the 8100 level, completing that bearish Gartley pattern, and that is in fact what has happened so far. It's been down hard 3 days in a row. There's a possibility here that we could completing a big AB equals CD leg down to the 76 level, and that would be enough to get the euro up into that 136, which is a very strong resistance in the euro if it should get up there. And remember, the dollar index is 50% in the euro, so there's a possibility, that could actually occur. We'll have to wait and see, but this is what we're looking at. The pattern did complete right where it was supposed to, and now it's backing off, to the downside. So we'll have to take a look at that. Now, I want to mention to you about the Japanese yen, because we have something possibly very, very positive happening in the Japanese yen. I know the dollar is weak right now, and that makes the yen, a little bit weaker versus the dollar. But there's a chance that we could have a ABCD correction again in the U.S. dollar versus the Japanese yen. We had one down at 80 on the hourly chart that I posted into the Tiger Den, and from that point on we made a big AB equals CD pattern up in the 84 level. Will be broke out above the 1.618 level, which was at the 8240 level, and now we have a potential to come down into that 8260 level in the dollar yen, and that would come right in the area where it broke out above the 1.618 retracement. It would be a 5-day pullback. And that's about all you got back in March. It went down from the 4th of March down to the 7th. That was 3 days. And right now we're in the 3rd day, and a couple more days down would take us to this level, and that would be a very low-risk entry point, to buy the dollar versus the yen, because I think this could be the real sleeper, as we've been saying, ever since it was, way back at 73 and 76, that this could be the sleeper of the currency markets for 2012. And, right now that's exactly what's happening. However, it could change at any time. We've got to take a little break here to pay some bills. We get back, I want to cover some more about the stock market and the gold market.
This is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com under newsletter. Hit the Market Insight tab for your 2-week free test drive right here, right now.
In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
Folks, turns out my best student became my best teacher. Steve Rhodes absolutely raised my standards, and I'll guarantee he'll raise yours.
Thanks, Tom. What I've learned is that if you want more, you must become more, and that transformation, folks, that occurs the moment you decide to become a master. Now, the quickest way to mastery is through immersion, and for 2 solid days in Denver, Boston, and Tampa, I'll create a new standard of wealth for those few trader investors who have a burning desire to succeed. At my Master Trader course, I'll teach you how to create the ultimate money machine. These are the best-kept secrets in the business. Roadblocks, folks. Dabblers give up when they first appear. Stressors last just a little bit longer, but masters expect roadblocks and achieve extraordinary results when they bust right through them. I have all the benefit of knowing the type of wealth creation that I can generate for you. You don't. That's why I'm making this unconditional money-back guarantee. If for any reason you're not satisfied with my Master Trader course, I'll refund every penny. That's right. I take all the risk, and you get all the benefit. Go to the homepage at TFN.com and sign up today.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back. Larry Pesavento for TFNN. We've got a call from Ari in Arcadia. Are you there?
Yes, Larry.
How are you?
Pretty good. I'd like to talk to you about SLV, but I'd like to make a comment about TBT.
Sure.
I did enter the TBT long, by the way.
Well, good for you. Go ahead. What can I do for you, Ari?
You and I have been playing around with the silver for a long time, going up and down.
Yes.
I normally wouldn't call you because it's the middle of something, but the fact that you're leaving, I like your opinion of silver for close, intermediate, and long term.
Okay, if we're going to just look at the SLV, which is the ETF for silver, which follows the silver almost tick for tick. There's times, when in the middle of the night it doesn't actually catch some of the swings, but I will cover the SLV right now, and then later in the show I'll cover the silver. But, we had a pretty good correction coming off that 61% retracement that was up on, March the 4th. And now what we're doing is we're just, in the trading range now. I think it's going to have some resistance up around $33 per ounce, and I would like to buy it if it gets down to the 28 level. That's what I'm looking at. The problem that I see, Ari, is the gold and silver stocks. I mean, they're acting so badly that it's very, very difficult, to actually, get bullish the gold and silver when the gold and silver index is not doing well. And then I'm also going to put up American South African, which is one of the larger gold companies, and you'll see that this stock, even though it's, completing a bullish Gartley here, that doesn't want to go up. So that tells me that for the shorter term, I think we've got a more correction coming in the gold and silver. That's what it looks like to me. Gold down maybe another, see, it's at 60, so about at $80 down to the 1585 level. But if you'll look at that XAU index, and those of you that go into Tiger TV and see this colorful chart that I put up, what I did was I hit the wrong toggle button, and it put up all kinds of oscillators and wavy lines that I have no idea what they are. I couldn't get rid of them, so I wanted to show the chart of the XAU silver and gold silver index, but I couldn't get rid of the pretty colors that are on there, and I can't make heads or tails out of them. I'm just looking at the patterns, and all I'm saying is that we've broken down here badly in the XAU, and that tells me that we're looks like that we want to go lower eventually. That's what I think we'll do, and then maybe higher later, but not right now.
Does that indicate that silver may take out the 128 at some time?
What do you mean, the 128? Or you mean the 28 level?
Yeah, the 28 level.
Yes, I think it could very easily do that. And the reason why I say that longer term is, we made that high in April when we had the big blow-off and the volume and open interest up at 49, and then we broke down and made the big ABC at 26, then we rallied up to the $36 level. And that was the 61% retracement of that previous move. And then just recently in March, we hit that 61% retracement again. So we've had lower highs and we've had higher lows. We're in a big triangle here. But the bias right now to me looks like it's going down only because of looking at the gold and silver index. But if these stocks start to pick up, then I think you've got a chance to, get it to move, a lot better. That's just the way I see it.
All right. I also don't know why the stocks are getting massacred, but they surely are.
Well, if you listen to Basil's show, there was a gentleman on about the Bank of America. When Bank of America was trading at $5 a share, back in October, when the banking index was making a beautiful bullish Gartley pattern at the 786, the whole world was bearish Bank of America, and frankly I was too, because if it went under $5 a share, that's a sign that it might not even make it. But something turned the stock. This last move that you're having here in Bank of America, probably a short covering, but I don't know that. It's like Basil said, don't stand in front of it. You don't need to know what the reason is. Just don't stand in front of it.
I appreciate it.
Hey, it's my pleasure. I hope to see you this spring. I used to go there the day after Christmas. I was there every day in Arcadia.
All right.
Okay, thank you, my friend, for calling in. I appreciate it. We got a call from Robert in North Carolina. You must be a Tar Heel fan. Is that correct?
No. I'm a Gamecock fan. I'm in South Carolina.
Oh, South Carolina. Oh, it says North Carolina on my prompt, so I'm sorry about that. Yeah. What can I do for you, my friend?
First off, I just want to say I hate calling into your show, Larry.
Yeah, I do, too.
I hate to interrupt you. Calling in, I'm going to interrupt him. Don't do that.
Okay.
But the reason I called in is we have a Mercury combust coming up this Wednesday, right?
Yes, we do. Yeah, we got a lot of stuff this week. This is big time week. I mean, this is. As a matter of fact, what I should do is if you'll go into Tiger TV, I'm going to just post all the transits so you can see them. It's really quite amazing because if you'll notice, they're all up in one side. They're in the Pisces Aries area, and it's really amazing. And they're on. If you look at the top part of the transit chart, you'll see that these are where the cycles are. And if you look at the middle of the chart, you'll see the things that look like little dumbbells. Those are the oppositions, and those are big also. So we've got a whole bunch of them coming together. This chart is very similar to the chart of March the 9th of 2009, except that every planet was in the same houses. So we're close, but it's just another big cycle. That's all I can say. You had a question about bonds? Is that what your question was, Robert?
Well, I was calling about James Hannigan. I was listening to his stuff a while back, and he had like the 60-year bonds cycle date is like April the 22nd of this year.
Mm-hmm.
And so I've been hoping that we're going to have a big sell-off and then have a big rally in the bonds, and we'll get that, that
final blow-off
at the end of the year. Yeah.
Yes, I'm a big fan of Jim. I've known him forever, and well, not forever, but as long as he's been in the business. And he's probably he's the number one GAN guy as far as I'm concerned. I don't know anyone that's any better than Jim Flanagan. And and he happens to be a good friend of Jim Twentyman also, and both those guys have studied GAN, a great deal. But I just posted into the Tiger Den the 30-year T-bond chart that Flanagan was talking about, and it shows interest rates when they were 14%, and now we're under 4% for mortgages, for the 30-year. So I believe we're topping up in here. Frankly, when we went below 40. In the bonds, that tells me 140 in the bonds. That tells me that the major top is in on the bonds. I missed it by a couple of points, I just have to wait.
Larry, I think he had April the 22nd as the 60-year anniversary of a particularly momentous high. So we may not have missed it. We may get one more shot at it.
Well, that's true. I haven't had much luck with 60-year cycles because I would only live through one of them, and I like to have more examples if I can. But frankly, the bond will probably give us a better chance to get in. That's just my opinion. I've had a trade of the year set up for the bonds. It's not working the way that I wanted it to because I thought we were going to get to that 150 level, as you know, Robert. And, we didn't get there, so who knows?
Well, I appreciate you chatting with me.
Okay, my friend. Nice talking to you, and thanks for calling in. And I'm rooting for the North Carolina team this weekend, so we'll see how they do.
Yeah, I hope so.
Okay, thanks a lot.
Take care.
Okay, I put the bond chart into the den, and you'll see that we were looking for prices to get up into that 149.50 level. We didn't get there, and that was going to be my trade of the year. This would be the first time in 15 years where I didn't get filled on the trade of the year. So I'm thinking of maybe switching the trade of the year to the SDS, but I wanted to wait a few days to get through this cycle that we have this week because we might have one more push to the upside. It certainly hasn't topped yet because we've made another little higher high in the NASDAQ and then also the S&P. But a lot of it is the emotionalism behind Apple. I mean, my goodness, folks, I've been in this business 50 years, and I've never seen a stock where there is not one person that is negative on Apple. I mean, that's just absolutely unheard of. That's no different than everybody being absolutely bearish on one particular stock. There's going to be a change no matter what. I think Bank of America is a perfect example of that. It's trading at 5 in October, and it has actually gone up more than Apple has. I mean, it's doubled in price. It's gone from 5 to 10. I mean, that's just an amazing move in a very, very large stock. I mean, that stock, has a lot of stockholders that have, doubled their equity. God bless them, and I think that's great. But, when things are really bad, that's when things usually turn, and when things are really good, I don't know what it'll be that could possibly make Apple, go down in price. But all I know is that Isaac Newton's second law of motion, for every equal action, there's an opposite reaction, and what goes up must come down, which is the second one. And second law, and that has always, been in our favor as we trade these markets. But we'll have to wait and see if it's actually going, to work this time. The main thing that I think we have to realize that this is the week. I feel very strongly about this. I don't know if you folks were following us back in 2007. I didn't have a full-time radio show then. I was only a guest on Tom's show. And, whenever I came on as a guest during that time, I would always talk about this date coming up of March the 5th of 2009 and, talked about it. And, of course, we had been bearish during 2007 and 2008, mainly because of the patterns and the Bradley cycle. And then I did say in March of 2009 that this was going to be the biggest short covering rally in the history of the stock market. And, in fact, I believe it did make it. And, we doubled in price in a matter of 3 years. And, whether it's going to keep going or not, I don't know. Long term, all the cycles from the looking at all the markets around the world, and when you do that, I look at through the eyes of the NYSE index. We're still in a bear market as near as I can tell. And, we'll have to wait and see. This is a real critical week, folks. Let me tell you. We've got today, tomorrow is the equinox. We have the a combust, Mercury conjunct the Sun on Wednesday. Thursday, we have the new moon, and it's one of those new moons that has extra power, mainly because of where it's sitting, and also where we have the solar flares are also out there. So it's just a big event. What'll happen, I'm not sure, but I'm pretty sure it's going to be something. Maybe the market will explode to the upside, never to be looked at again, but we'll have to wait and see if that's going to be the case. I'm not 100% sure of anything. All I can tell you is that something big is in the winds. We've got a call from our friend in Palm Harbor, Florida. Jim, are you there?
Yes, I am, Larry. How are you?
I'm good, thank you. What can I do for you?
Two questions for you. One is basically this non-confirmation with the SPY almost at the 5-year high with the NYA, just around the 618.
Yes.
But I wanted to start with Apple. I saw an Apple print at 605 on a before the market opened this morning. How do you reconcile those? And you see that a lot of time after earnings. How do you reconcile that data, or you just ignore a print like that?
Well, I don't really do much in stocks, but I ignore prints like that, and the reason why is what it is. It's either an emotional. In other words, there's nothing in the market, and like there could be bids at like $5.99. Even 01, and someone wants to do 3,000 or 4,000 shares, and the only way you can get that filled is if it's bid up, because those are the only offers that are above the market. So you can't really count that as you have to count it as a swing, of course, but frankly, it's not indicative of doing that. That happens to us, in the currency markets occasionally in the middle of the night. You'll see something, squirrely like that occurring. And, who knows, why it's going to do that way. But it's actual trading, so you should count the swing because it's real money. Real money, transformed there. So
and I really don't know who supplies that data, because everybody seems to reset it when the market opens at 9:30. At least I know some of the feeds I look at reset, and like TBT had a real wild range today from 2079 to 2055. And I wasn't even looking at the prints at 8:01 this morning, so I just don't know how people.
Well, I have several different data sources coming in for my Forex and futures that I watch just to make sure, that I have anything. And if I see something, anything off the ordinary, I call Jim Twentyman immediately, because Jim's specialty is precise data. He will not stand for anything that is not absolutely perfect. He's a consultant for CQG, Commodity Code Graphics, so I get pretty good data. And but that's something to be concerned about. And what I would do is to try to check another source to make sure that data is correct.
All right. And then what I really wanted to talk to you is just with this non-confirmation again between like the SPY or the SPX being real close to I'm looking the SPY back to 07 right now.
Yes.
143, and now we've clawed our way all the way back, and yet the NYA is showing that non-confirmation. I don't know what other indexes you've looked at that are...
Well, I go back and, historically I look at a lot of things because this is how I, gain my experience at looking at the cycles. But if you go back and look at the divergence of the NASDAQ to the S&P or the New York Stock Exchange Index, so where we were in 2000 when the market was topping, and then 2007 when the market was topping, and now where I think we are now, the rate of change of the NASDAQ is extremely steep, whereas, we're not getting the same thing. In other words, the NASDAQ is leading us up, and that's only 100 stocks. And I don't think that's a fair assumption of what's really happening out there, because these are cap-weighted stocks, and Apple is 20% of the NASDAQ, and then when you add Qualcomm to it, which is a big supplier of the stuff for Apple iPads, that's a weighted average. Stay with me, Jim. I want to talk to you a little bit more about this divergence.
Okay, thanks.
Mm-hmm.
At At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, I just want to let you know I did give you some jewelry. My jeweler offered me about $650, but you get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, good.
And very happy.
Well, I appreciate it. Now, Did you sell us jewelry or did you buy coins off us?
I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
The strength in the NASDAQ stocks of those 100 high-tech stocks compared to the rest of the market. So I think it's important. This divergence has always been, well, actually, you can't say always because the NASDAQ didn't start until 1972. It didn't become popular until the mid-'80s. And so you don't have a lot of, years to look at. But over the last 30 years, whenever you have a major divergence like this, it's telling you that the market is extremely vulnerable here, based on the things that you look at. Does that make sense?
7 high. SPY's back to the October 07 high. The IWM, the Russell, is almost back to the May 11 high. So it's only the NYA that seems to be underperforming unless there's other indexes or groupings that I'm not looking at.
Well, I basically look at the New York Stock Exchange Index. That's the one that I look at the most. I know that the small caps have been really strong because I've been watching that. But recently, the small caps on this last move have not been nearly as strong as they've been in the past. Looking at the Russell. So we'll have to wait and see if that's going to be the case or not, and wait and see.
The other key would be the transports too. But I remember, Larry, 3 years ago, you said it was going to be the mother of all short covering rallies. So you really.
Yeah, well, every 3 years I'm right. So you be careful now. This is the third year.
Well, it's almost 3 years. 3 years, 36 months exactly. So
yes,
hopefully you're
it certainly is. Yeah, in fact, we passed the anniversary date of that. Just a few days ago, so we'll have to wait and see. The main thing is that you got to respect the Bradley model, folks. I mean, I've done a lot of work on it. There's, not many people have done this, the work behind it, and someday it's going to be very, very famous, I believe, and not because of me, because it's Bradley's idea, but the theory behind it really does work. If you go back and look and you've got 126 years of samples, that's a pretty good, that's a tremendous sample size, and when you look at the correlations at how well they work, it's a pretty good thing.
Hey, last question. Do you have a projection for the S&P right now, the June?
Yeah. Do you want the next 2 minutes, or do you want a little farther out?
Well, no. I mean, before you hang up, I didn't know if you had an extension.
I'm looking at a possible 1407 today. That's a 1.618 expansion on the half-hour chart. But frankly, it doesn't mean anything because you're over these cycles, and they could, move up. Even stronger until it's finally over. When it's finally over, if I'm right, and we're going to know this week. I don't believe this. With this new moon coming in on Thursday, it's going to be, it's going to cause a lot of, emotionalism in my opinion. And we got Combust tomorrow on Wednesday, so all these things are, really coming to a head, and that tells me that we should have a, pretty significant turn. And what it will do is it'll be pretty dramatic. I imagine 200-300 points to the downside, which would be, 30 S&P points or more.
Okay.
Would be the first move. I thought it happened when we had the big move down on the full moon of March the 7th. Remember, the Dow was down 200 that day, and the S&P was down about 30. The NASDAQ was down about 65. Well, there's just a 2-day sell-off, and then the market continued to go up. I think it was because it's waiting for what's happening this week.
So are you going to have a sell stop someplace in the middle of the night that triggers your alert that says, hey, now's the time to enter, rather than trying to pick a top?
No, I'll try to pick a top. There's no question about that. I go in at point D, and look, I'm looking at 1407 today. We'll see. Okay. Hey, thanks for calling in, Jim, and we'll talk to you on Wednesday maybe.
Yes, thank you. Bye.
Thank you.